Today, we will talk about what is blue chip stocks complete guide. What is a blue chip stock? A blue chip stock is a huge company with an excellent reputation. These are typically large, well-established, and financially sound companies that have operated for many years and that have dependable earnings, often paying dividends to investors. A blue chip stock typically has a market capitalization in the billions, is generally the market leader or among the top 3 companies in its sector, and is more often than not a household name. For all of these reasons, blue chip stocks are among the most popular to buy among investors. Some examples of blue chip stocks are IBM Corp., Coca-Cola Co., and Boeing Co. Understanding a blue chip stock. While dividend payments are not absolutely necessary for a stock to be considered a blue chip, most blue chips have long records of paying stable or rising dividends. The term is believed to have been derived from poker, where blue chips are the most expensive chips. A blue chip stock is generally a component of the most reputable market indexes or averages, such as the Dow Jones Industrial Average, the Standard & Poor's S&P 500, and the NASDAQ 100 in the United States, the TSX 60 in Canada, or the FTSE Index in the United Kingdom. The safety of blue chip stocks. While a blue chip company may have survived several challenges in market cycles, leading to it being perceived as a safe investment, this may not always be the case. The bankruptcies of General Motors and Lehman Brothers, as well as a number of leading European banks during the global recession of 2008, are proof that even the best companies may struggle during periods of extreme stress. Blue chips as part of a larger portfolio. While blue chip stocks are appropriate for use as core holdings within a larger portfolio, they generally shouldn't be the entire portfolio. A diversified portfolio usually contains some allocation to bonds and cash. Within a portfolio's allocation to stocks, an investor should consider owning mid-caps and small caps as well. Younger investors can generally tolerate the risk that comes from having a greater percentage of their portfolios in stocks, including blue chips, while older investors may choose to focus more on capital preservation through larger investments in bonds and cash. What makes a company a blue chip? Blue chip stocks are the titans of their sectors, industry-defining companies that are well-known, well-capitalized, long-term stable plays with solid financial prospects. What companies are considered to be blue chips? Many of the largest companies in the S&P 500 or the Dow 30, such as IBM, JP Morgan Chase, or Walmart. Many stock market investors prefer blue chip stocks due to their stable earnings. Blue chip stocks usually pay increasing and consistent dividends over time to at least partially make up for any temporary declines in the stock's price. During economic slowdowns, investors turn to blue chip stocks to protect their investments. For example, during the financial crisis in the last decade, some blue chip companies survived the crisis and investors who held shares in these companies were able to recover their earnings. Investors in blue chip stocks are generally assured of receiving regular dividend payments and having their portfolios protected against inflation. Where does the term blue chip come from? The term blue chip stock comes from the world of poker, where chips used in gambling have different colors to represent different dollar amounts. A blue chip is typically the one with the highest value of all, surpassing white chips and red chips. Are blue chips a good investment? A diversified portfolio might include the ownership of a rash of blue chip stocks, meaning the stocks of large, well-capitalized, well-understood companies, among a variety of other holdings. In addition to owning individual stocks, investors may also seek to have blue chip exposure through the purchase of mutual funds or exchange-traded funds, ETFs. How do I invest in blue chip stocks? A market participant can buy blue chip stocks individually, or by buying mutual funds or exchange-traded funds, ETFs, that invest in blue chip stocks. In some cases, funds and ETFs will hold a variety of stocks and asset classes, including blue chips. In other cases, the funds or ETFs might be focused exclusively on blue chips, such as an ETF that tracks the Dow Jones Industrial Average, which comprises 30 of the largest blue chip stocks. One of the world's largest crypto asset exchanges is ready for you. Enjoy competitive fees and dedicated customer support while trading securely. You'll also have access to Binance tools that make it easier than ever to view your trade history, manage auto investments, view price charts, and make conversions with zero fees. Make an account for free and join millions of traders and investors on the global crypto market. Origin of blue chip stocks. The term blue chip was first used to describe high-quality stocks in the early 1920s by a Dow Jones employee, Oliver Gingold. Oliver was standing by the stock ticker at the brokerage firm when he observed some shares trading at $200, $250, or more. He told Lucian Hooper of Wee Hutton & Co. that he planned to go back to the office and write about these blue chip stocks. The term's been used since then to refer to high-priced stocks, just as blue chips in poker typically carry higher chip values. Blue chip stocks do not necessarily need to be highly priced, but should be of high quality. Benefits of blue chip stocks. Blue chip stocks are generally considered to provide a safe harbor during economic downtowns. Some of the companies listed on the Dow Jones Index, such as Coca-Cola, General Electric, and Procter & Gamble Company, have survived major economic slowdowns well over the years due to their strong balance sheet and excellent management teams. Such companies are capable of buying out and driving out weak competitors after a crisis, therefore strengthening their financial position even more. As previously noted, blue chip stocks typically pay consistent and steady dividends to their investors. Research shows that dividend-paying stocks tend to be less affected in bear markets. Investors can sometimes live off the dividend payouts during their retirement and pass on the wealth of their stock holdings to their children when they die. Some investors love buying blue-chip stocks on the theory that the strength of the financial statements of the issuing companies means that their income is protected. Inexperienced investors often target investments that they think will make them rich quickly. More experienced investors, especially those who have already acquired wealth, tend to focus more on establishing sustained income for the future and on protecting their existing wealth with stable investments, even if those investments only offer a more modest rate of return. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.